The Fed is accelerating its pace of monetary policy tightening much more aggressively than financial markets had anticipated. This development is likely to put downward pressure on asset prices, particularly on the prices of the most risky asset classes. This video will discuss the Fed's recent statements outlining its plans to take away the punch bowl much more quickly than it had indicated earlier. Next, it will describe how the financial markets reacted during the previous monetary policy tightening cycle. Finally, it will consider whether the financial markets will react differently this time than they did during the previous tightening cycle. Over the last few months, we've learned that the Fed intends to end quantitative easing in March instead of closer to the end of next year, begin hiking the federal funds rate as early as March this year instead of waiting until sometime next year, and start removing liquidity from the financial markets through quantitative tightening, perhaps soon after quantitative easing ends in March, instead of several years later, as most financial market participants had assumed until last week. This aggressive acceleration of tightening is likely to put significant downward pressure on asset prices during the months ahead, particularly given how expensive most asset classes have become relative to past norms.